Right now, the Fed funds rate is its highest level since 2007. Powell said we're likely going to see another hike. Janet Yellen now saying not even any discussions about fully insuring deposits. Which one of those situations do you see as being the biggest catalyst for that steep sell-off that we saw yesterday?
I mean, you and I were on the phone when this was happening, doing a pre-interview. Chair Powell, I thought, was doing a very good job during his press conference. Striking a fine line of acknowledging that inflation risks still exist, while still acknowledging also that there are stresses in the banking system. And I thought markets were reacting very positively to those comments until Janet Yellen made her comments regarding the FDIC insurance. And it shows you how fragile sentiment is within the banking sector, in particular the regional banks. And that was enough really to put everything into a very sharp sell-off. Things were going fine. I thought the market was reacting well to the rate increase and the commentary by Chair Powell, but all that was pretty much upended by Secretary's comments regarding the FDIC insurance.
Yeah, sell-off yesterday. Seems like people are digesting those comments now. We're seeing futures higher right now in the pre-market, but certainly something to watch. So let's talk about portfolio management right now in light of this news of the hike and also what Janet Yellen said. And then also, how are you judging companies right now? What are the metrics that you're looking at? Before bond yields jumped, a lot of people were looking at dividends. What's really important right now?
Well, look, you can't be reliant on the capital markets for companies to access capital if they're burning cash right now, because it's very unreliable. The cost of capital has risen dramatically and is going to rise further, particularly as perhaps banks pull back on lending. So what you want to do is find companies that are generating a lot of free cash flow. We target companies that generate over 100% free cash flow to their net income, their free cash flow conversion, and are looking at companies that have under-leveraged balance sheets, because our belief is that companies can deploy capital through mergers and acquisitions of strategic, smaller types of deals that can be additive to their earnings and perhaps grow through a macro landscape that might be slowing down. And then those companies will just stand out a lot better.
All right, so Dan, you gave us three picks, actually. One is Ametek, ticker AME. The other's Fortive, ticker FDV. And the other's Roper, ticker ROP. All of them have a dividend under 1%. Let's talk about the valuations of these companies and how important the valuation is in some of your picks.
Valuation is really important. These three companies I mentioned when I was with you last back in January. They've continued to execute really well. I'll note with regards to dividend, we're focused more on dividend growth and less so on dividend yield. These companies all grow their dividend above average, and that's extremely important. But again, it's that free cash flow conversion that gives them tremendous optionality of what to do with that capital, and having a sound capital deployment plan is so important.